Winston and Felix here. And the ugly truth is that retail investors will always lose as long as they're fearful. Let's make more people less fearful so that more people actually get to live their life they deserve on their own terms. That's my goal here, sharing the information that Wall Street banks are sharing with their big clients and that they don't really want you to know because they don't circulate it to you. So shall we dive into that? Let me take you through some data points, a little bit what happened last week, what's likely going to happen in the coming week, as we are literally in the middle of a rainstorm here on a beautiful mountain. And this guy, he loves the rain so much, he actually wakes me up when it starts raining heavily in the night. He's like, come on, let's go outside, let's get wet. So let me walk you through last week. Who made money last week? Institutions, lots of it. Let me tell you how much. Institutions bought on the 5th of August, the Japan dip, the sort of mini crash, right? Institutions bought significant amounts of stocks that day. We know from JP Morgan, whereas retail investors dumped lots of stocks. And the gains since the 5th of August are as follows. Nvidia, plus 37%. The Japanese stock index, plus 22%. Bitcoin, plus 20%. Tesla, plus 19%. Meta, plus 17%. Amazon, plus 17%. So buying the freaking dip is usually a good idea. And they know that. They've got the statistics. They've got plenty of spare cash lying around. And that's actually what makes the difference. So before I walk you through all of the important data points here, you got to ask yourself, what would it take to overcome your fear? Winston, any thoughts? Let's get Winston back in the picture here, shall we? There he is. Come on. Okay, Winston looks a little suitably water ratty this morning. So ask yourself, what do you need to overcome fear? What if you were given $500 every Monday morning, and then on Monday morning the market dropped 5%? What would you do? Would you not feel like it was walking into, I don't know, your favorite retailer, Walmart or whatever it is, and everything was on discount? Well, that's basically how institutions feel because they have an endless cash flow, right? Money is generated every week. Wealthy people generate money every week from their investments and from their trades. So that's basically the way Winston and I get over the fear. We generate money pretty much every week, most weeks at least, from trading. And if you want to learn how we do that, then come and join our first ever workshop on Tuesday. And by first ever, I mean first ever, because we've never done that kind of format of teaching before. It'll take 2 hours, and we'll literally teach you our structure, our rules, how we do it. And maybe you too will be able to generate some income, and therefore you'll actually enjoy the dips and you'll feel good about them, because we were quite celebratory when that dip kicked in, because we were like, brilliant, we can get buy our stuff cheaper. But let me walk you through the most important data points for the week ahead. So again, you're less fearful, you're better informed, or you're better in place to make good decisions. Winston, you look a little sad. Why do you look so sad? Nice and muddy. Okay, so the value stocks picked up during this crash. So investors were fleeing growth for value. Now, what we're seeing now is that they're going back into growth. That's partially because we're expecting more rate cuts. So that's quite positive. So again, that kind of shows like all is actually well in the whole growth land. But the real trend of quality over low quality has been something I've been banging on about for like a year. I just saying like this is a stock pickers market. This is not a buy the index market. And that continues to massively outperform. So high quality stocks, high gross margins, good profitability, good revenue growth. Those stocks have done way, way, way better than the kind of average rubbish. So being in the S&P index is just not really paying off right now. And I think that's going to continue for quite some time. Goldman Sachs just said further optimism from here as the consensus shifts towards a higher growth forecast, which is super, super positive. And I'll walk you through the earnings growth, which is quite staggering in just a moment here as well. And the way they describe it, they always say, what's the pain trade? Because institutions trade up and down equally. They don't really care which way the market goes, nor do we. They're basically saying that investors have added back more than 50% of what they originally unwound since July, which means that with rate cuts on the horizons, really good earnings, strong economic data, the market's going to go up. That's Morgan Stanley saying that. And if you look at fear, that lovely little CNN indicator, the fear indicator, well, we're still in fear. Well, what does Buffett say? Be greedy when others are fearful, right? We've just been in extreme fear last week. So it's kind of fairly obvious that dip buying was a good idea. And we did dip the buy, didn't we, Winston? He's watching the birds, I think. And if you look at sentiment, which is sort of like, are we overly exuberant or not? And crikey, it's getting dark up here, isn't it? We should probably wrap this up before we get washed away. Sentiment is at 0.6. Now, it can go to 2 or 3 or whatever. So it's not stretched, which basically means as long as earnings keep coming in the way they have, and as long as everything out there, going to get rate cuts and so on, there's a lot more money to be deployed, and the market could get a heck of a lot better than you might think. And the real reason for that is to look at this chart. I'll put it on the screen here for you, the rocket ship chart. The S&P 500 Q2 earnings per share, so profits per share, has massively shot up, almost like a straight line up. And that's ultimately what drives the market, is precisely that. It's like how much are profits going up by? And then you got to look at, well, which sectors are outperforming? Utilities. Are you in utilities? Probably not, right? Are you in infotech? Probably. Are you in financials? Like JP Morgan. We did a trade on JP Morgan last week that did very, very well. Healthcare. That's things like LLY, United Health, right? Those stocks, the whole sector's done super, super well. Discretionary has also done very well. I'm getting a little bit more cautious on discretionary because I think the consumer is going to get a little hit here with this recession thingy coming up. So if you take all of that into account, all you got to really look at is the data, which is what happens when we get rate cuts. Who benefits, right? Utilities, financials, growth stocks, biotech is going to come back. All the stuff that basically boomed when we had low interest rates, right? Remember the sort of post-COVID world where interest rates were being, were super, super low and money was being printed. We're basically heading back towards that world. We might not get back to, 0% interest rates. They might stay at 2 or 3% for a long time, and that's okay. But still, a 2% cut in interest rates should give us a 15, 20% rally in growth stocks. So all that risky stuff, all that sort of ARK stuff, that's what should come back. And if you realize that, well, then, it might be interesting to position yourself into that. So we've got trades open on crypto again. We got rates open on some of the better quality names in healthcare and JP Morgan and, all these kind of things. And I think if you know how to read the tea leaves, it really isn't that challenging. It really isn't that difficult. You still need a good strategy and good risk management and good automations and good exit rules and all of that. That's super, super important. But it's kind of like you can see what's coming. And if you're wrong, well, then your risk management kicks in, right? And what I'd love for you to get to is that, you chase returns like this guy wants to chase those lovely birds back there in a safe kind of manner where you're diversified. You're not just going, there's this one stock and this is what's going to get me to financial freedom. That's very unlikely to happen. It'd be a real stroke of luck, and I hope that you get that luck. But you do need to have a bit of a broader strategy and not just be the pure tech investor or the pure Palantir or SoFi investor or PayPal or whatever it is. Although I think those stocks are also going to massively benefit from this, especially PayPal and SoFi. So I'd love for you to join us on Tuesday. Go to felixfranz.org/workshop. It's free. We do 2 hours of teaching, answering your questions, giving you our strategies. We'll run through some real trades together. I'll give you some like challenges to answer and think through and stuff. And really just get yourself that financial education that those buggers on Wall Street don't want you to have. So you can have a beautiful, happy, fun life. And, you know, this is the life, isn't it? Getting really, really wet on the top of a mountain. Winston, go. What are you doing? There are these sort of pheasant-like birds up here, and he's rather intrigued by them, but don't worry, he doesn't get them. He's not quite quick enough, thankfully. Any final words, Winston? Learn how to have fun so we can go to the beach every day. Yeah, I think that's ultimately what life's about, isn't it? I wish you a beautiful start to the week. Start to really, really profit from what the heck's going on out there. Let me know what you've been making money with and what not down below in the comments. And I hope to see you on Tuesday. All the best. Felix here. If you're worried about how far this market's going to crash and what's going to happen to your favorite tech stocks next week, then this is the video for you. We're going to run through Nvidia, the S&P, the Nasdaq, Palantir, Apple, Tesla, Microsoft, Neo, Alphabet, Amazon, Meta, PayPal, SoFi, maybe one or two other names we can think of along the way.